Welcome to the EACC-NY's EU Spring Economic Update, Sailing Through Calmer Seas. This event is organized by the European American Chamber of Commerce, New York. My name is Yvonne Bendinger-Rothschild. I'm the Executive Director, and I will be your host and moderator for today's event. My conversation partners include special guest Maddalena Peretti, an advisor at the ECB's Representative Office in Washington, D.C., Balázs Pakányi. He's a counselor for economic and financial affairs at the EU delegation to the United States, also in Washington, and Ben Carlina, senior economist, together with Balázs at the EU delegation to the United States. The European Union has weathered the impact of Russia's invasion of Ukraine much better than expected. Commodity price shock from 2022 is now a thing of the past. And Europe has pivoted from Russian imports of oil and natural gas with pivoted away, I should say, with amazing speed. And that together with the resilience during the COVID pandemic, along with various public funding schemes, has allowed the EU to shrug off fears of a recession and actually allowed it to continue an economic expansion in the second quarter. So we've just seen the spring forecast, and we have upgraded the outlook from the autumn forecast. Balázs and Ben, do you want to give us a quick broad strokes of where we are and how we got there?
Yeah, thanks very much, Yvonne. It's a pleasure to be here once again. And I just wanted to start by saying, you know, a year and a half ago when we were talking about the outlook, we were wondering whether the reopening after COVID was going to be another roaring 20s decade of high growth and high spending and wild living. And I think that, you know, one of the explanations for how well Europe has done over the past year really is about the continuation of some of these reopening trends. Now, of course, as you noted, the war in Ukraine threw a monkey wrench in the plans to have a big party, because that's really been a terrible thing that has happened in Europe. But nonetheless, the stage was, as before the war happened, that you had a very strong labor market where people had remained connected to their jobs in Europe. So as soon as the economies reopened and people could go out again, it was very easy for everybody to return to work. And employment was growing, hours worked were growing. A lot of these indicators were solid. You had all these pent-up savings, so people had money in their pockets that they could spend, and they wanted to spend it on in-person services and tourism. And so these were the sectors that really boomed, the ones that had been constrained during COVID. So restaurants and bars and hotels and construction that had all been shut down, reopened, and things were great. And then, boom, you get the war, you get these enormous increases in energy and commodity prices. And because Europe has to import so much of its energy, this was a huge terms of trade shock. It was worth roughly 3% of GDP that Europe was having to spend more on, and that they were just sending to the rest of the world. And so everybody was expecting a recession. The Commission had 2 consecutive quarters of contraction in the fourth quarter of 22 and the first quarter of this year. But in fact, that did not happen. And why didn't it happen? It basically happened because Europe proved to be much more resilient than the pessimists had it. Europe managed to have its imports of Russian natural gas, which is, you know, the key component for a lot of not just electricity generation, but also some, you know, manufacturing and people used to heat their homes and stuff like that. So Russian imports fell by half, and this was replaced much more quickly than people thought by new supplies of liquefied natural gas from the US and Norway and the Middle East. A number of these floating offshore LNG platforms were set up off the coasts of Germany and the Netherlands and Finland. On top of that, I think 56 gigawatts of wind and solar capacity was installed, which had a meaningful impact on replacing gas. It's true that some countries shifted to less clean energy sources like coal as a temporary measure. But all of these things on the supply side, Europe managed to, people were worried that they were going to run out of gas in the winter, and that did not happen. The gas reserves were filled, and at the same time, demand for gas fell. So you had a nearly 20% contraction in how much natural gas was used. To some extent, there was a little bit of a reduction in output in certain energy-intensive manufacturing goods, like for chemicals and some kinds of minerals and paper and stuff like that. But manufacturing as a whole, output was actually higher in 2022 than it was in 21. So the manufacturing sector as a whole did not suffer as much as people feared. And households also, turned down their thermostats because heating homes is a big component of gas usage. A little bit warmer than normal weather helped. And so all these things combined, the resilience in terms of energy markets, the underlying strong labor market, a lot of excess savings that were sitting there. And we got 3.5% growth last year. And now the new forecast is calling for 1% growth in the EU this year and 1.7% next year. So, what that means is, yes, it's a slowdown, but given how much better these numbers are than what people were expecting, it really sets the stage for a much better than expected outlook, and I think we should feel good about that.
Yeah, let me
if I
dive.
can just, sorry, Johan.
Yeah, Balázs, do you want to? Because I was going to dive into energy and get
No,
a little more into that.
While we are sort of on the broad overview, and then perhaps we can also have a quick look at the slide slide 5 with the GDP outlook, because Ben was already talking about it. I just wanted to augment a little bit and chip into what Ben was saying, is that besides the surprising flexibility of the European economy in terms of substituting for energy and weathering the energy crisis that we all feared would push the economy into recession last year and early this year. We have to also mention that the supply constraints, global supply constraints, have also eased, which helped a lot. The New York Fed Global Supply Chain Pressure Index also shows this, as it was continuously declining throughout 2022, and now actually has dipped below the level that it was pre-pandemic. So one can argue that the supply constraint, easing of the supply constraints, also helped the economy. And as Ben was already alluded to, and we're going to talk about this, I suppose, later on, is the strength of the labor market. Just in the US, the EU as well has seen a very strong labor market, which helped this resilience that we've seen in the forecast and in the past couple of quarters. Just to give you this additional information before we dive into the details, but I'm happy to talk further questions that you have.
Yeah, thank you for that. Madalena, do you want to give us a quick intro, or should we dive into some of the topics that Ben and Balázs set the stage for?
Perhaps we can delve into what we covered now, so we don't distract with moving on to inflation.
Yeah, sounds good. So energy, I want to dive into that a little bit, because that was one of my, on a personal level, the biggest concerns. Energy, 3 factors that go into it: building up the reserves, what does it cost, switching to renewables, and then tackling demand, both from industry and private demand. What did it cost the private sector, or how did we manage so fast to ramp up the switch to renewables? I was mesmerized by how fast that came together.
Yeah, I think it took everybody a bit by surprise, and I think that there was a combination of public sector interventions that provided a little bit, because one of the things about why prices spiked as high as they did last year was because of this rush to refill storage. And suddenly, global energy supply chains were being rejiggered because Russian exports to Europe didn't, by the end of the year, they basically stopped completely. And the Russians were trying to figure out what to do in terms of changing where their energy exports went, and Europe was competing with other existing countries to import LNG. And so first, I think is the one thing that is surprising is that all these offshore LNG terminals could be constructed so quickly. I don't think that a lot of people had that. And luckily, because of the way that some of the existing pipeline networks in Europe worked, once you purchased gas from the United States or from Norway or from Qatar, and the freighter, the tankers arrived, then it could just go right into these pipelines that got most of the places where they needed to go right off the bat. But then you also had people switching from gas-fired electricity to other sources. I mean, one interesting thing is that gas usage in Spain, for example, actually went up last year. And the reason for that is because the Iberian Peninsula is sort of on its own network, and the Spaniards were able to ramp up their electricity production using gas and then export that to France, who in fact needed the energy because some of their nuclear capacity was down, and they were also having trouble with some of their hydro capacity because the rivers were so low. So you have a bunch of shifts in terms of how the energy comes in, but you also have new capacity in terms of firing up some older, dirtier plants, but installing a lot of new green energy. And I think actually part of this comes from, member states acting very quickly to provide some funding for these things, but also businesses doing it, and some RRF money that I think might have helped, at least in terms of it, people knowing that it's coming. And then, of course, people often say about high prices that the cure to high prices is high prices. And that's probably one of the reasons why consumption managed to go down as quickly as it could, that people had alternatives. They could turn their thermostat down a little bit. Businesses could figure out more efficient ways to run their factories. And all of these things combined showed that the European economy overall was much more flexible than people feared.
That and allies coming together, and collaboration within Europe. I was following, the LNG terminal set up, and we can pump it in here and then send it over there. I mean, it was like a logistical feat to get that going and to get all of the markets supplied, some of which, like Spain, and I believe Portugal as well, being a little bit, I don't want to say disconnected, but connected elsewhere in a different way.
But also, I think it's worth pointing out that now that gas prices and oil prices have come down as much as they have, that really changes the game. I mean, oil's back to $80 a barrel. Gas is what is it, $50 per megawatt hour is how they commonly quote prices in Europe, which is still a little bit above the pre-war numbers, but much lower than the peaks. And so this means that you have sort of a reverse positive terms of trade shock coming, because all the pain that was instilled in the initial shock is now going away. It's one of the reasons why headline inflation has come down, but it also means that there's going to be, more money available for consumers and businesses to spend and invest, rather than spending it on energy that ultimately the producers are outside of Europe and the money goes elsewhere.
Yeah, for sure. And I'm really excited about optimizing corporates being able to optimize production processes. I mean, I think they should have done that years ago, but I'm happy it's finally happening. And you know, which bode well for the future. I want to move on to the labor market. Balázs, do you want to give us a more in-depth analysis of what we're seeing there?
Of course. So as I was mentioning, or also Ben was mentioning, that the labor market continues to be a bright spot in Europe and has helped a great deal in preventing a recession, a technical recession, and sustaining economic growth. As you can see on this chart, even before the pandemic, there has been a nice downward trend in unemployment. So we've been coming down from around 11% in 2014 to the vicinity of, say, 6-7% before the pandemic. And there was a spike, obviously, because of the pandemic. Everybody stayed at home. Maybe the spike wasn't as high as in the U.S. because of the various temporary work schemes that European governments put in place. Yet there was still a spike, and then as the economy was reopening, everybody got back to their jobs, or they haven't even lost their jobs, and this continued. The unemployment downward trend continued, and now we have reached historic low levels. So it keeps at that level. So we thought already that the last quarter of 2022, we had hit the bottom at 6.1%, but it turned out that we could even go lower. We are now currently around 6%, and the forecast sees this to stay at this sort of rock bottom level going forward. And not just the unemployment figures, but also other figures are very encouraging. The activity rate is around 65%, which is also a historically high number. The employment rate is at 61%, and all the labor market slack measures show a very tight labor market. So that was very good. People have jobs. They can also spend it, right? So this is also important that they can have income besides the fiscal support that they've got from the governments for the pandemic and energy crisis. So that's helped the forecast for sure. A little bit going into details. I would also point out that young people who were most hit by the pandemic, as you can imagine, the age of between 15 and 24, when they were supposed to come and get their first jobs after university or whatever education they got, and they couldn't do that because of the pandemic. So they were the ones that most hit. They were most hit by the COVID. They are coming back too. They're coming back and getting their first job. So the gap that they have shown with other cohorts is closing. So that's very encouraging as well. Of course, we also have immigrants coming from Ukraine that could also be mentioned. So far, around 4 million people have arrived in Europe from Ukraine. And about 2/3 of them are a working age population. So there's a big chunk of people coming from Ukraine. We expect to continue also. They're probably going to increase the immigrants by another 500,000 in this year and next year. And already about quarter of the people in the working age population immigrating for refugees from Ukraine have already found a job. So that's also supports our employment figures.
Jump in for one second with that. I want to dive a little bit into that, because here in the US, we have major problems with finding skilled labor. And in the situation of Ukraine, a lot of skilled labor, professionals like you and I left the country. So there was a huge influx of very skilled professionals into, I'm not going to list the individual countries, into the EU as a whole and other places as well. What are we seeing in terms of, or Europe having similar issues around finding skilled labor as we see in the US, or is that a different situation across the EU?
Definitely, we do. There's the skills shortage, just like in the EU, that you can see in Europe, and that's also the reason why companies are reluctant to let their employees go. And that's why there's sort of like labor hoarding. And despite the fact that there has been a slowdown in economic activity, we don't see unemployment rise at all so far. So well, we expect that this labor hoarding is going to continue. And even with the immigrants from Ukraine, this skills shortage will not be fully met.
How about how is that affecting wages?
That's a very good question. So, so wages have been increasing, which they have been increasing by, say, about 5%, if I'm not mistaken, last quarter of 2022, which is relatively high in historical standards, right? But it's still below inflation levels. So while wages are increasing, and we expect them to increase further this year, the employees will not recuperate their lost real income until some time. So that helps the consumption based on this income, helps to support the economy, but there are still sort of ways to go for them to another way to put this, that we are not currently worried about any wage price spiral because they haven't recuperated all of their lost real income.
And I don't know if we want to get into it at this point. Let's address that when we get to inflation dynamics. Unless do you want to add a couple more points on the labor market? I would love to move on to
Sure.
you know, inflation dynamics and financial market stability. Madalena, do you want to give us an overview of what the view of the ECB is on that?
Sure, of course. First of all, I missed a couple of points because of my internet connection, but based on what I heard so far, I think you mentioned a lot of the key issues that also matter for inflation. So this reverse terms of trade shock from inflation prices going down, the strength of the labor market not being reflected sufficiently still in wages. So those are you know, both potentially positive and negative for the inflation outlook. What we see overall is headline inflation is going down. There is agreement amongst forecasters that disinflation is coming in 2024, 2025, but what we see is that we're nowhere near the ECB's medium-term target. So there are a few interesting points to note. While headline inflation is going down, you have underlying inflation pressures remaining very high. What does this mean? It means mostly that while in headline, this impact of lower energy prices and supply chain bottlenecks easing, so here, you know, delivery times are getting shorter, input prices are lower. In general, shortages of equipment are no longer a problem. So all of this puts downwards pressure on headline inflation. At the same time, in core, you might have lags in seeing the effects of these positive developments. So core inflation remains a bit stubbornly high. And once these lags clear out, then we will see another type of dynamic that we cannot read perfectly right now, which is the impact of the labor costs. So you were talking about wages picking up. Will they pick up sufficiently that real wages catch up with inflation, and also profit margins? But before I go into the wage and profit margin role in inflation, I wanted to touch a bit on the differences here that we see with the US. I think for obvious objective economic reasons, US news dominates financial market sentiment, right? But at the same time, now we might start to see a bit of divergence in the inflation dynamics, or rather, we have seen divergence since the beginning. So you have these supply side shocks were much more important in Europe. Now they're clearing. So that's good news for Europe. But what we might start seeing is a bit on the demand side impact, which the US has already experienced, right? So real wages are picking up, consumption is going up. This is good news. In the US, this already happened really extensively already in 2020. So you had goods consumption way above pre-pandemic level trends in the US already at the beginning of 2020. Services consumption already picked up in 2021. In the EU, they were below pre-pandemic trend until the end of last year. So this is, of course, good news for the economy, but from an inflationary perspective, you might see then demand side pushes. So this is a bit things to keep in mind when looking at the euro area compared to the United States. Now, of course, when we look at this, from a central bank perspective, what the Governing Council has said very clearly is that they care about, inflation, headline inflation. So that's for their medium-term target. Headline inflation can be noisy. So then you also look at core, because it gives you a bit of an indication what happens in the medium term. And then you also have to look at how the monetary policy transmission is going. And in that sense, we do see a tightening of financial conditions. What does this mean in practice? It means, that funding costs for banks are higher. It means that credit standards are tightening, so banks are much more selective in giving out loans to households and firms. And of course, bank lending rates are going higher, which is what you expect when you have restricted monetary policy. At the same time, it's probably true that all of this is not.
We have a little bit of a. Madalena is frozen. I'm wondering until we have her back. When we were talking about goods versus services and core inflation versus headline inflation, maybe Ben, if you want to talk a little bit about how that is affecting different sectors.
Yeah, absolutely. So I guess one thing that's worth pointing out is that when we talk about these aggregate numbers, it does mask a little bit differences in different parts of the euro area. And there are differences between countries and between sectors as well.
Not enough. And in the latest, which was on the 4th of May, was based on the data they had at that point, they just have basis point.
I think we have Madalena back. You put yourself on mute.
Yeah.
I'm trying to switch.
There we got an echo.
Okay, I'm trying to switch devices. I'm sorry. What did you hear? When did I freeze? I realized I froze.
Core inflation versus headline inflation, and what that means. And I was just asking the effects of it, and I was just asking Ben about the sectors that are affected by those developments.
Yeah, I was just going to say that, talking a little bit about some of the regional differences between countries and also the different sectors. But I think, the main point is that in Europe, it's the supply side that has been so dominant right now. And so things have been feeding through from energy prices. And the fact that energy prices are coming down is great for headline. But when you start looking at core, it's been more persistent in the United States and in Europe. So it raises these questions about how much of it is driven by demand and how much do interest rates need to go up to kind of lower the levels of aggregate demand. And especially in the United States, there's been this debate about how much does the labor market tightness need to ease, and can you get rid of that tightness without increasing the unemployment rate too much? And that's sort of the big debate amongst economists and central bankers and all that. But I will stop there and let Madalena get back to the point that she was making.
Yeah, thanks, Ben, for that comment. What I was also asking myself in this context is, so if the financial markets are if it's harder to get access to capital, that is also affecting different sectors differently. So what are we seeing trend lines on that, or is it too early?
Well, so there's a slowdown in the housing sector already, and that is expected to continue because real estate is such a interest rate sensitive sector. But one interesting thing, at least anecdotally, the commission conducts these business surveys and asks businesses about their investment plans. And you might expect that as credit conditions get tighter and interest rates go up, that businesses are going to invest less. But in fact, business, at least as reported by survey data, business expectations about their investment plans for this year and next have not changed that much. And I think that that reflects, to some extent, this confidence in the underlying demand. And also that, you know, in 23 and 24, like in contrast to the United States, where the economy, people debate about whether there will be a recession or a soft landing, but they agree on the direction. Things are slowing down. And the slowdown is going to happen in the US very likely in the second half of the year into 24. But if you look at the outlook for Europe, there's, you know, little tough spot in the fourth quarter, but now because of lower energy prices, think growth prospects are better than people thought, and they're expected to accelerate into 24. So despite higher interest rates and tighter credit, you've still got businesses planning to invest.
Yeah, and yeah, I saw those same numbers, and also we are seeing it as an organization. You know, companies are really investing, taking steps to invest. We see that them coming to the United States, or Americans going to Europe. I want to talk a little bit more about the interest rates. Maddalena, do you want to go into that a little bit further and just kind of elaborate on the thinking of at the ECB and what monetary policy can do and what it can't?
Sure. I hope I have better luck with the technology this time, but so what did the Governing Council decide at its last meeting on the 4th of May? I don't know if you heard that when I mentioned before, but basically that they would raise our key interest rates by 25 basis points. And that, I mean, is already quite a significant hike. If you look at when we started hiking 9 months ago, we already hiked overall by 375 basis points. In parallel, of course, even though, you know, the primary tool remain interest rates, then the ECB is reducing the Eurosystem's portfolio under the asset purchase program. And it's planning to discontinue reinvestments for the APP in July, although there's a bit of optionality on that date. So this is what they decided in early May. And I think what's really important now is that we have to keep in mind that the ECB and the Governing Council is now taking a data-dependent approach. So what you can know is that depending on incoming data before the next meeting, decisions may continue. But the President Lagarde in her last press conference made it clear she believes there's more ground to cover there. But the Governing Council has also been quite transparent, even though we no longer engage in forward guidance, we've been quite transparent in the reaction function that they're going to adopt. So, looking at headline, underlying inflation, and at the financing conditions. So the transmission of monetary policy and how strong it's actually been, which ties back a bit into what you were saying, how much is this already impacting the real economy or not? Because of course, the monetary policy transmission channel is a bit long through the financial system before it hits the real economy. And there are normally lags, we expect these, and it's very important to adopt a data-dependent approach right now to really make conclusions ahead of its next decision.
Thank you for that. We talked already about the corporate outlook and how corporates are affected by access to funding. Just a few words about the backlog of bankruptcies. We're doing a seminar on that in the next in Q3, I want to say. What are we seeing in terms of bankruptcies? Is this worrisome, or
I can jump in on that one,
Yeah.
Yvonne. So yes, we've seen an increase in bankruptcy rates across Europe. That's true. And there's a nice analysis in the forecast actually looking at the bankruptcies. And what the colleagues in Brussels have found was that there are at least two reasons for why we've seen this rise in bankruptcy rates. One is a regulatory change in Spain, which came into effect mid last year. And due to the fact that actually Spain is, I think, like the third largest, has the third largest population of companies and SMEs and mid-sized companies in Europe. So whatever changes they have, it will have an impact on the Europe as a whole. So there was a change in insolvency regulations in Spain last year, which was actually beneficial for the debtor. So that meant that many of these companies, which were sort of already in limbo, so to speak, have started to make use of this new, more beneficial regulation to go ahead and resolve their activities. So that was one reason, but that we can expect that this is sort of a one-off, right? So this is not something that was a huge shock to the Spanish economy by any means that would have created such insolvency wave. And the other reason seems to be that that during the pandemic years, there was some government measures that would have insulated the companies to some degree from going into bankruptcy, because we thought like this is a huge shock, and we don't want otherwise healthy companies to go bankrupt just because of this huge healthcare crisis. And we have put in place measures that have put off this sort of bankruptcy procedures for some time. And what we're seeing right now is actually this backlog of bankruptcies being cleared in many of the member states. So again, this is more like catching up with past years rather than anything worrying going into the future, I would say. So I think this is one way to look at it. Another way, I think also what Magdalena has already alluded to is profits. So what we've seen is that despite the rise in energy costs and inflation, it seems that the companies were able to maintain their profit margins, and they actually have quite a healthy balance sheet on average. So that also suggests that that we don't see any major worries about a huge uptick of bankruptcies in the corporate sector.
Yeah, I have to say, this is exactly what I'm hearing. I mean, people due to the support measures, you know, during the COVID pandemic, companies were able, you know, companies that were, you know, relatively healthy were able to put money aside, save money. They didn't have to spend everything they had. And now find themselves, despite the supply side pressure that is still there, despite high borrowing cost and you know, initially reduced demand, they're still, you know, willing to invest because they had money set aside for a rainy day and they didn't need it for the rainy day. I think the report is estimating a growth in terms of corporate spending and investment growth up by 2.1% in 2024.
That sounds about right. And let's not forget the Recovery and Resilience Facility that's also rolling out money. And I think we can put up the chart on slide 4 for this point. And that's obviously public spending, what we see in this chart. But the idea of the whole RRF, Recovery and Resilience Facility, is to crowd in private investment, because we very well know that the green and digital transition is not something that the governments can alone finance. So there's a great need for private investments to come in. And the programs or the plans, the recovery and resilience plans that countries have put forward have a huge green and digital part. So this is the overall amounts that you see on the chart that will be rolled out or are being rolled out to member states, and they're going to end up being a public spending. But that also means that that they're going to crowd in a lot of private investment, and that also supports and upholds the corporate investments that you were talking about. And just quickly, just looking at the chart, so you can tell, the top two bars are the 2024 and 23, that this is going to give a stimulus or an impulse to the economy, the growth going forward this year and next year.
Yeah, I mean, let's dive into, thank you for that. Let's dive into a little bit about how much money is already out there, and is it being spent? And if so, can we take any trend lines from those numbers?
Well, I mean, I don't have at the top of my mind the exact figure, but I think that we're well past I don't want to say anything that's not accurate, but you can see already in this chart that, for example, France and Italy are the two countries, among the large countries that have gotten a large chunk of their money. For example, France has got around 1% of GDP, and Italy as well. And they have this money ready, right? So even if some of the projects that they have included in their recovery and resilience plan is longer term or being implemented as we speak, they have already this money in their coffers, and they're ready to be deployed. The reason why there's already more money with member states than what they have already spent on investments, and the reason why we think that it's going to continue stimulating the economy, is that the way the recovery and resilience plans and facilities is set up is that the countries don't necessarily get the money after they have spent it. So it's more like pre-financing of their investments, and the money is also linked to structural reforms, which is important because this will also create an economic structure that's more conducive for growth and investments, and it's more future-proof, if you wish, because of the green and digital investments. So it's not just about investments and spending the money, but also about reforming the economic structure itself. So you see that some of the money is already out there, and is being spent this year and next as well.
Yeah, let's talk a minute about sovereign debt. How is the GDP to debt ratio developing across the European Union? Oh, you have a slide.
Debt to GDP is falling, and this has been happening, despite the fact that EU member states have been running budget deficits. So this gives you a sign of how much nominal growth has been expanding. And, I think it's worth pointing out that also, I just want to shift gears a little bit and point out how resilient Europe has been, not just on energy, but in terms of withstanding tighter monetary policies and some of the spillovers from banking sector stress in the United States and in Switzerland. You had a very brief period where, junk bond spreads widened, but you never saw any big movements in sovereign bond yields against German bunds. And even the increases that you did see were pretty temporary. And I think that points to, on the one hand, transmission mechanisms working properly, but also that from a regulatory and a supervisory standpoint, the European regulators have done a good job of making sure that banks are well stress tested, that they can, that they have enough capital and all of that to weather these short-term periods of instability. And that, I think, is also reflected because of charts like this, where you see that the public investments that countries have been making to cushion the blow from higher energy prices, and then to promote the green and digital transition through investments in, wind and solar and new pipeline electricity transmission, things like this. These are going in a direction that are going to be supportive of growth. They're not subsidies that are going to just be wasted or subsidize inefficient activity. And this is one of the reasons why there's like a backlog of RRF funding, because people have been pretty careful to try to get a plan together. They have to come up with some structural reforms, as Balazs was saying, but then you actually need to spend the money in a productive way, especially if you want to crowd in private investment from the business sector. So all of these things kind of fit together to promote the kind of investments that are going to make Europe a more productive, wealthier economy a couple of years down the line.
Yeah, and that's in itself is a fascinating topic for which we are planning a program, because this is not your regular run-of-the-mill government stimulus package like we've seen them in the past. This is a very, very thought-through approach to where to put money, how to deploy it, and etc. But this will, go way beyond the scope of this program. I want to talk a little bit about, fiscal policy, supporting the goals of monetary policy. Madalena, do you want to talk a little bit about that?
Sure. I think basically everything that Ben was mentioning goes right to the heart of the issue of how fiscal policy can support monetary policy, right? So the issue is right now quality investment in productivity enhancing projects. It can really help, and of course we've seen the very important support to vulnerable households and firms during the pandemic was clearly very important, but now perhaps can be rolled back, and this will also be supportive for monetary policy. I think overall on the NGU and the public investment side, good news for the economy will end up being good news from a monetary policy perspective as well.
Yeah,
and maybe also just to add that a lot of the RRF money has been specifically designed to go to the countries that need it the most, and so many of the EU states that are bordering Russia have been most affected by the war and the most disrupted in terms of their energy supplies. And if you look at, things like employment and whatnot, like they haven't been like necessarily the strongest performing members of the EU, but they get a disproportionate share of these investment funds. And so that helps to smooth things out and try to get the various EU countries more so on the same cycle.
Yeah, and just to let's dig into that a little bit further. External factors. So U.S., China, Ukraine, three major issues that are, affecting the developments, I should say, developments in the U.S., China, and the Ukraine affecting the European economy. Starting with the U.S.
Well, so the U.S., the U.S. is clearly slowing. The U.S. started to have inflation problems a little bit earlier than in Europe, started to raise benchmark interest rates a little bit earlier than in Europe. And so the Fed, appears like it's reaching the end of its tightening cycle. You might have another, but probably not more than another 25 basis point increase, depending on what happens with the inflation numbers. But I think that in general, so the US is slowing, and the demand for European imports in the United States, or to put it another way, the prospect for European exports to the US to grow significantly in the next 2 years isn't that high. There's not going to be a lot of support from the external environment generally to help support the European expansion. Surprisingly, I think that's also the case with China. Even though China reopened much later, obviously there's certain European sectors that benefit from China's reopening, all the luxury goods exporters, for example. But people do have the expectation that while China's reopening is going to help a little bit, it's not going to help as much as it did in the past, because more of the benefits of the Chinese reopening are going to be absorbed domestically within China. So all this is a way of saying that the external environment has some risks to the downside. Thus far, it doesn't look like it's really going to hurt, but it's also not providing as much of a support as you might like.
Yeah.
But I think, yeah.
Is the debt ceiling discussion in the US going to keeping you up at night?
I think that there's going to be some tense couple of days in early June, and then it will get resolved.
Okay, your word in God's ear. Do any of the others want to comment on that, or we asked the American on the panel?
Yeah, I think we let the American leave that to the comment there. But of course, I mean, it's something that we will have to watch very closely, and we hope for a swift political resolution.
Yeah.
On the external environment, I wanted to make a comment that I think is a little bit more positive than what Ben has just said for the European economy. So as we were discussing at the beginning of this program, there has been a huge shock in terms of energy prices, in terms of trade shock in the past years, which is being unwound now. So this decline in energy prices is actually a positive. This reverse terms of trade is actually a positive for the European economy, and that's something that should help its net export, and should give a little bit of boost at least to the economy. I just wanted to add that as a positive note to the external environment.
Yeah. So what speaking of what keeps you up at night, what are some of the remaining risks that we need to kind of keep an eye out?
I think on the financial sector side, I mean, vulnerabilities in general remain high. This is not, we have to keep a very close eye on that. But I can reiterate everything Ben said in terms of the resilience of the banking sector thus far. So, a bit, this is the story for a lot of this, is that preparedness has really helped. So the fact that banking supervisors were very proactive in the euro area and the banking union has clearly helped, also in terms of banks' ability to react to monetary policy tightening. That's something that supervisors really started in Europe to stress for banks that they had to keep an eye on early on in the inflationary cycle, right? So preparedness helps, but that doesn't mean that that risks are tilted to the downside right now, because they are probably more outside of the banking sector also. And then, yeah, I think corporate real estate is also something that is quite high on the agenda in terms of things we need to keep an eye on.
Yeah, for sure. I don't want to continue to bring that up, but we're going to have a program on corporate real estate and the developments there. Balázs, when we talked earlier, you said there is a downside risk, but in the past, we were blessed with a lesser downside. Do you want to elaborate on that?
Yeah, I think the way I like to think about it is that I consider that we are lucky so far, and it's much better to have a forecast like a series of forecasts like we had. Like we had forecasted the recession in the winter. We thought there were downside risk, but then it ended up being much better than we thought. And I hope that this is going to continue in a way that we get surprises on the upside going forward. And I think there are also chances for that too. It's not just all downside. If you think about whether the core inflation is now has stopped broadening, so hopefully it's gonna go down as well, just like headline inflation, which will help households in regaining their purchasing power and could provide an upside to the economy itself.
Yeah. And to add to that, I think another potential upside is just a significant improvement in sentiment, because I think, especially in the United States, the war in Ukraine has always seemed pretty far away, and people don't necessarily appreciate how much of a shock it was to people and how much there was this expectation that bad things were going to happen. And obviously, things are still ongoing over there, but to the extent that a couple pieces of good news happen and people start to feel a little better, the fact that there is these underlying, people still have jobs, they have excess savings, if energy prices and inflation starts to come down, they might have a little more money to spend and feel better about how things are going. Things like this are not guaranteed, but it's an upside risk. It could happen, and it would be helpful.
Yeah, and even, I mean, if you're looking what's happening in the Ukrainian economy, I'm amazed that people in Ukraine still have jobs and they're going to work every day. I mean, it's incredible, and not only in Kiev, in other places as well. I mean, it's fascinating. Madalena, do you want to have a last word?
I don't know. That's a lot of pressure. I think I joined Balázs in the hope that there is news to the upside. Yeah, and I just want, by the way, echo this on the Ukrainian economy's resilience. It's really been very impressive, and we really need to watch and learn from that.
Yeah. Maybe I let Kristalina Georgieva, the managing director of the IMF, have the last word. She actually quoted in her last analysis of the global economy, Nelson Mandela in the beginning and then at the end. And she said, "I have discovered that the secret that after climbing a great hill is one only finds that there are many more hills to climb." And she ended her analysis with, "I have taken a moment here to rest and steal a view to the glorious vista that surrounds me, to look back on the distance I have come." So I think we've come a long way, and I mean, I am very bullish on not only transatlantic relations, but on what's awaiting us in the economy. I mean, if we're looking back to the beginning of COVID, but then also the war, we thought that things are going to turn out way worse than they have, and I don't think we've just gotten lucky. We were prepared, like Madalena said. We put measures into place, and I'm quite optimistic about the future. And so are our members. I mean, we're adding members left and right, and we see a lot of investment interest both in Europe and the United States. Companies looking for partners. So I'm bullish on the outlook, and both in the US as well. So we have a CEO dinner. I will let you know if the CEOs that we have invited tonight are equally bullish on the future.
Well, so are we, and you should know that the European Commission is forecasting no recession in the United States, just a slowdown. Yeah. So I share your sentiment, and hope for the best.
Yeah. So this concludes today's webinar. Thank you so much to our panelists, Ben, Balázs, Madalena, for joining us, for sharing your insights with our audience. And EACC members on the webinar can check in with us if they want to connect to anybody who has also attended. Looking ahead, like I already said, we have a commercial real estate market update. We have a AI and human analysis. Who is the master of the analysis and why that is an important question. And then we have a new type of program, Meet Your Future Self, where we have an executive, a very established, accomplished senior executive, talk about what it took to get to the top. And with that, thank you. Enjoy the rest of your day, and we see you at our next program.